Okay, well, good evening. Welcome to Policy Exchange. I'm Chris Yu. I am head of the Digital Government Unit here at Policy Exchange, so I look after our work on technology, data, and the internet. And I will be chairing this evening. We're delighted to have with us Stephen Ezell. Stephen is a Senior Analyst with the Information Technology and Innovation Foundation in the United States. And he's author of the book Innovation, Economics, and I think there are a handful of copies here, so if you want to get your hands on one, then you can talk to Stephen after the session. This evening, we're going to spend a bit of time on the importance of innovation in the economy. Stephen's going to tell us some of the highlights from the book that he's recently published and talk about some of the causes of industrial decline in the UK and the US and what governments can do to help build a pro-innovation, pro-growth agenda. And I know that some of you will have seen the front cover of The Economist this week. It's a timely moment for those who haven't. The front cover looks like this. So it's a person deep in thoughts on a flushable toilet. And the headline says, will we ever invent anything this useful again? A lot of people have been talking about innovation. Is innovation slowing down? Have we gone past all of the killer inventions in humankind's history? I kind of hope we haven't. I'm pretty optimistic about these things, but maybe we can pick some of that up in the conversation at the end. So in a moment, I'll hand over to Stephen. He will talk us through his perspective on this for maybe 20 minutes or so, and then we'll open it up to a discussion in the room, and we can be pretty relaxed about this. Feel free to ask questions, pick up on any points that Stephen raises, or put your own comments. Okay, so without any further ado, I will pass you over to Stephen.
Well, Chris, thank you, and thank you to the Policy Exchange for the invitation to be here with you this evening. So in November 2012, at his Lord Banquet speech, Prime Minister David Cameron said, quote, "Britain is in a global race that is a moment of reckoning for every country, and we need a modern industrial strategy if Britain is going to compete and win in the race to create the highest knowledge, highest value-added goods and jobs in our economy." And our book is really about that and about the contours of what we call a fierce race for global innovation advantage that has emerged among nations. The genesis of the book actually starts with our work at the Information Technology and Innovation Foundation. We're a nonprofit, nonpartisan technology and economic policy think tank in Washington with the mission of advocating for public policies that drive innovation-based economic growth around the world. But being situated in Washington, we're constantly being visited by representatives, policymakers, politicians from countries around the world. And when they're in DC, they want to connect. They want us to connect them with the science and technology innovation policy community in Washington, the movers and shakers. And of course, they want to know what's going on with innovation in the United States. And we found ourselves constantly scratching our heads. They'd come in and talk about all these fancy new innovation strategies and investments that they're doing in key industries, and we wouldn't have all that much great to say about what the US is doing to drive innovation. So to lay out what other countries are doing in this space really was the start of the book. And you know, I think one thing that's shifted in the world fundamentally is that nations have moved from being price makers to price takers. And what I mean by that is that countries used to be able to dictate the terms of the deal to companies. But now with globalizations, companies can shop the world to locate their globally mobile investment. They can choose in which country to put new R&D facilities, new plants and equipment. And what happens is these companies shop the world and they ask Britain, Egypt, Israel, Germany, China, what do you have to offer us in terms of the best access to pools of skilled talent, the most attractive regulatory and competition regimes, the best tax rates, the best incentive structures? And it's that competition for globally mobile capital that's really accelerated this. And what you find is that there are policymakers in countries around the world that wake up every morning and ask, how can we do whatever it takes so that we can attract, scale, and grow the highest value-added sectors of economic activity? And I think you see that particularly accelerated just since the year 2000. So what are these countries doing? They're putting in place national innovation strategies and national innovation foundations. In fact, we document in the book 4 dozen countries that now have articulated national innovation strategies, and at least 3 dozen countries with national innovation foundations, whose mission is to support private sector innovation in their economies. And in at least a dozen of these cases, in countries like Sweden, Denmark, Holland, Uruguay, South Africa, they've really set up these strategies and foundations within the past decade. That really shows you how this competition has really accelerated. One of the things you're seeing these countries do as part of their national innovation strategies is to declare the 7 to 8 key sectors of their economy in which they want to be absolutely sure their country leads. So they identify the sectors where they have competitive advantage vis-a-vis other countries, and then put in place the platform investments in scientific research, in skills, in infrastructure to support the competitiveness of those sectors. China, if you look at their Innovation 2020 strategy, has declared 7 critical sectors, and they are going to invest the equivalent of the US stimulus package, about $780 billion in each of those 7 sectors over the next 5 years. So that's the level of competition we're experiencing today. And I think that the reality is it has been a very tough decade for the US and the UK economies. We document in the book really the failure of the US innovation economy over the past decade. Our economy in the 2000s didn't create a single net new job. Household incomes in the United States have remained stagnant since 1983. We accumulated a $7 trillion trade deficit with the rest of the world in the 2000s, including an annual trade deficit of $100 billion in advanced technology products, the high-end stuff like clean energy, biotechnology, ICT, that the United States should be leading in. We lost a third of our manufacturing workforce, which is a rate of decline worse than during the Great Depression even. And US industrial output over the past decade declined by 10%, the only decade in American history that's ever happened. Unfortunately, I think you can look at the UK economy and maybe see some of the same indicators. I understand you have a 7.9% unemployment rate, 2.4 million Brits out of work. At least over the past 12 years, average incomes for your citizens are stagnant. And part of that, I think, has been a lack of traded sector competitiveness to some degree. So Britain's share of world exports declined by 33% between 2000 and 2010. You lost about 50% of your manufacturing jobs since '87, and there's structural challenges. Like the US, you're at about 90% or more of a debt to GDP ratio. And there's some question about adequate investment in the future. Our data shows Britain as 15th in R&D intensity among OECD countries. We also see this in where countries stand in innovation. So ITIF's flagship report, if you will, is one we call the Atlantic Century. What this report does is ranks 44 nations on 16 indicators of innovation capacity. So your classic inputs like government R&D intensity, level of patents, scientific publications, new startups in the economy, entrepreneurship, et cetera. So we got, of the 16, we have 12 innovation inputs, if you will, and then 4 innovation outputs in terms of how fast countries are increasing their productivity, how fast they're raising per capita GDP, their trade balances, their levels of foreign direct investment. And when you look at the data, things don't seem so bad. In fact, on these 16 indicators among these 44 countries, the United States is 4th and the UK is 6th. And when we present this study in the US, people say, well, okay, what's the problem? 4th is pretty good. And the ones you have at the very top, Singapore, Finland, and Sweden, those are smaller economies, more homogeneous societies. We can't really compare ourselves against them. That's not fair. Okay, but what we did was we rolled the tape back to the year 1999 and looked at the rate of change, the rate of improvement in performance on these 16 indicators and found that over the past decade, the US is 43rd out of 44 countries, ahead of only Italy. UK is 24th. And what this shows is that our fourth place position is really based on residual strengths, the investments we've made in the past. We're resting on our laurels, essentially, and not raising our game to the level of competition that exists in the world today. So why is this? In chapter 3 of the book, we argue that the two most radical industrial declines that any modern economy has ever experienced was the UK from the 1950s to the 1970s and the United States over the past decade. And as bad as those 2 decades were for you, our past decade was just the same when you look at decline in jobs, output, et cetera. And so chapter 3 identifies 20 common causes, 20 common factors of decline between our 2 countries. And I'll just briefly mention a couple that I think are important. One is significant underinvestment. I mean, investment is the single most important factor determining industrial success or decline. And when you look at both of our nations over these periods, investments in R&D, in plant and equipment, in knowledge, in workforce training, significantly underinvesting relative to our peers. Part of that being a focus on offshore overseas rather than domestic investment. Part of it being companies' corporate investment cuts. But as Sidney Pollard writes in the book, The Wasting of the British Economy, he talks about how the Treasury Department from the 50s to the 70s, that investment was low because the whole panoply of government was designed to keep it so, because Britain was concerned about running, essentially its currency going down or running a trade deficit. So we need our policymakers, even now, even when budgets are tight, to understand there's a distinction between spending and investment, and we have to continue to invest for our future. Short-term market focus, a focus on dividends and rate of return, a real problem across both economies. There was just a study done of US Fortune 500 CEOs. 82% said they would cut R&D to meet quarterly earnings targets. They'd cut out their future just to satisfy capital markets today. A real problem. Another problem is that corporations are increasingly paying out their profits as dividends instead of reinvesting in the future. So when you look at the ratio of dividends to corporate investment, in the 2000s, at the start, it was about 20%. Today, it's 60%. So we're paying out instead of investing in the future. Adversarial labor management relations, a real problem across both countries. And I think at its heart maybe was a focus on being a consumption economy instead of a production economy. Pollard talks about how economists in Britain and the United States were focused first and foremost on symbolic figures like prices, exchanges, and balance of payments to the neglect of real quantities produced and traded. So economists have to focus much more on the industrial composition of their economies, what we're really producing. A belief that manufacturing isn't necessary was a problem in both countries, as was this dominant neoclassical economic perspective. I think Paul Krugman is a great example of this. He talks about how productivity growth is the single most important factor of any economy's well-being. But he says it's not a policy issue because we're not going to do anything about it. Right? Neoclassical economists just tend to reject a role for government in the marketplace, a role for government in spurring private sector competition. And I think the countries that lead today are not discarding what the neoclassicalists teach us, but they're augmenting it with a new understanding, much of it coming from the literature of Schumpeter originally. It's a new field of economic study, actually called endogenous growth theory or new growth theory, but it's ultimately innovation economics. And it says that the central goal of economic policy should be to spur higher productivity and greater innovation. And it recognizes that markets relying on price signals alone won't always be as effective as smart public-private partnerships in spurring greater productivity and greater innovation. Ultimately, this point of view rejects the notion that innovation is like manna from heaven, as Robert Solow said, that innovation is the result of intentional human action, and nations can put in place better innovation ecosystems to spur innovation on. It also notes that neoclassical economics is fundamentally about the study of allocative efficiency. If you go back to every economics 101 textbook you all read, the first line, always and everywhere, is economics is a study of the optimal allocation of a scarce set of resources. If we're talking about widgets, economics is about how we optimally allocate a scarce supply of widgets. But as Schumpeter says, the more relevant question isn't how we allocate widgets, but how we produce them more effectively, what he calls adaptive efficiency, or how we replace the widget with something better entirely, which he calls dynamic efficiency. The point is, innovation should be about the production, not just the allocation. And we have to get our economists to think more about this. The best countries find a way to get what we call the innovation triangle right. Here we talk about the business environment, the regulatory environment, and the innovation policy environment. So business environment is like good management skills, strong levels of entrepreneurship, churn and change, dynamism in the economy. The regulatory environment are your factor conditions, your tax, trade, regulatory competition policies. And then your innovation policy environment underlies this with innovation strategies, with investments in science and technology, with commercialization strategies, with investing in digital and physical infrastructure. So no country in the world really gets all of these things right, but the one that does will lead in innovation. I commend Britain. I think in the past year you had the highest level of entrepreneurship you've had in your history. In the US, we're at a 30-year low, so you're doing something right with your business environment. But there was a great study done by Eric Bartlesman of the Free University, and he looked at the rate of innovation between European and American firms and found that it was the exact same rate of new product development and discovery. But essentially that the US had much more fluid labor and capital markets, which let us scale to our winners much more quickly than Europe did. So getting the regulatory environment right is very important. We'll talk more about this in the Q&A, but we believe very strongly that there is an appropriate role for government in spurring private sector innovation. And we in the book talk about this continuum of left to right. We see industrial policy as what was practiced by France when they sponsored Group Bull to go up directly against IBM, or they sponsored Quero against Google, or in the 1970s, the Japanese and Koreans calling out specific national champions in concrete or shipbuilding. Okay, modern innovation policy doesn't do that. It doesn't pick and invest specifically in firms, but it does call out key broad technologies and industries which a nation wants to be competitive in. And I think critically, it doesn't invest directly in firms, but it invests in their innovation competencies and their ability to innovate through shared research platforms, like the Fraunhofer system in Germany, which brings industry and university together in a collaborative way to pump money into a sector, but to broadly share the research results among companies, among industries, to build technology roadmaps, et cetera. Leaving it principally to the market just isn't good enough, I think, in the modern economy. 2 more slides, and then I'll wrap up, if I'm okay on time, Chris.
Yeah, fine.
So I think it's very clear when you look at the evidence that countries are competing for innovation-based economic growth like never before. But this creates real opportunities, but also real problems for the global innovation system. And we can think about a matrix of types, of qualitative types of innovation policies in such a way that when a country puts them in place, it leaves a result that is either positive sum or negative sum for the world. So countries can compete on good innovation policies, investing in R&D, investing in science, investing in skills. And this creates positive spillovers for the entire world. If the Chinese sponsor a company that develops a cure for cancer and they corner the global cancer solution marketplace, good for them, right? If they won competing fair and square through scientific investment and they came up with a discovery, that's great. Benefits them, benefits us, benefits the entire world. Unfortunately, we're increasingly seeing a number of countries putting in place policies that are designed to win the innovation race through what we call innovation mercantilism. putting in place policies like forced technology transfer or intellectual property transfer as a condition of market access to their economies, forced localization, trade barriers, currency and standards manipulation. These types of policies will indeed help one country win in this race, but they distort the entire global system and they cause all other countries to lose. There's actually also a set of bad innovation policies out there. If you're familiar with South America and India's use of import substitution industrialization strategies in the 1970s, what's ironic is that they're coming back to them today. India just announced that by the year 2020, 80% of all electronic goods sold in India must be manufactured inside the country because they want to stimulate the development of an indigenous ICT marketplace. But what economists have found when India tried this in the 70s was that for every dollar of tariffs they put on ICT products to deter imports to build their own industry, it caused a $1.30 loss to their broader economy because all the other sectors of their economy lost productivity because they relied on this critical technology as an input. So this was a bad policy that hurt the country and hurt the entire world. And then finally, we can think of a self-destructive policy, which we specialize in the United States, like limiting high school immigration. When we have people who want to come and study and stay and invent new companies in our country, now since really 2001 with our visa policies, we kick the best talent out. And that's totally self-destructive. Hurts us, but helps everybody else. The point of the slide is for policymakers to push to that upper left-hand quadrant and promote good innovation policies that generate win-win outcomes for the entire world. And so that suggests that what we really need to get to is what we call a new global innovation consensus, or a Bretton Woods for the global innovation economy. And we really need to reform global institutions like the IMF, like the World Bank, like the WTO. First, so that their policies only support the good innovation policies I just talked about, and are less focused on helping developing countries build export industries that will compete against us, but more focused on helping them raise the productivity of all sectors of their economy across the board. We propose in the book creating what we call a global science and innovation foundation. It's great. There are a lot of companies investing in R&D, but there are a number of overlap, duplicity problems. There are some free rider problems when some countries free ride on others. So what we should do is say that all countries will contribute 0.25% of their GDP to this Global Science and Innovation Foundation, which will invest in research to address commonly shared global problems like disease pandemics, like global warming, like dealing with aging, and work collaboratively to solve some of these problems. We absolutely need a free trade pact between the US and Europe. We have to be the leaders of driving the global trade agenda forward. No two sets of nations, Europe and America, or regions, believe more in free trade, so we have to spearhead this process going forward. And we think, finally, let's do something in partnership. Let's get together with England and say the US and England are going to come up with a commonly shared grand challenge that we put out there that we're going to solve for the betterment of society, a terrible disease, something we can collaboratively work on to produce better outcomes for the world. Those are the contours of the book. Thanks for listening, and I look forward to Q&A.
Good stuff, Stephen. Thank you very much. Extremely interesting and thought-provoking, and nice to see at least one chart in there where the UK was ahead of the US. So I should warn you that we've had our share of self-destructive economic policies here from time to time. I'm going to open this up to questions from the audience. So if there are things that you want to pick up in that, then let's talk about them now. I'm going to slightly abuse my position as chair to ask you a question which has been bugging me a little bit, which is really about, you were talking about that continuum of innovation policies. You have poor on either end and good modern innovation policy in the middle. And you were saying it's about choosing broad sectors to support rather than choosing firms. And I guess my question is, how do you decide, how does a government decide which broad sectors to go after? So in the UK, for example, we've got this package of measures that was in the autumn statement and in the previous budget around life sciences and pharmaceuticals. And it feels kind of broadly sensible that the UK should push on that. But how do we know? Is there a scientific approach to that, or have you got to be bold and just kind of bet big? For the politicians, what's the way through?
Well, I think that most countries can now agree that you absolutely have to get the factor conditions or the framework conditions right. So making sure your regulatory policy, your education policy, your infrastructure policy, the environment to support innovation. I think that's table stakes now among countries. That's being done. To answer your question, I do think that it's possible for governments to look at the industries in which in which the economy has long-standing competitive advantage, maybe natural advantages due to resources, clusters, skill sets, specialties in university knowledge or skills, and call out those, half a dozen or so key sectors that are globally traded, which face global competition, which account for above average shares of your output, your employment, and your consumption of R&D dollars.
Yeah. And how do you deal with, so I can see how that works looking backwards, right? So we can look back through history and say that the UK is particularly strong in these fields of academia and life sciences and so on. What about when you look forward to things which are a bit younger, right? So the UK government has also invested a lot of money in open data, and we've got this Open Data Institute, which is supposed to help people work with open data and generate all these new applications that don't exist yet. Is it okay to bet on that stuff as well?
I think when you look at the contours of the global economy now, post-industrialized economies like the US, like the UK, we know the kinds of sectors that we're no longer going to be competitive in, right? So, so much of the commodity-based, labor-intensive manufacturing, the whole parts of the economy we can look at and know now in the future that's not where we want to play. Yeah. So the only way that the US and the UK economies like this can compete is on very high-end, very high value-added, very knowledge-intensive sectors of the economy, whether that's in manufacturing or goods or services. So I think looking at those high-knowledge, high-value-added sectors are the way to get there, and I think it is both on knowledge side and service side, and also on the manufacturing side.
Okay. Who would like to put a question? The gentleman at the back first. If you could tell us your name and where you're from, that would help as well.
Roddy Gow, I'm the founder of the Age of Scotland Institute, which was set up in Scotland last year. And what our mission is to equip with the necessary skills of tomorrow's leaders, the young people, so that we can fire up what is in the DNA of Scotland, or was, that took their great-grandparents, great-great-grandparents from a small country that had a huge impact in Asia and elsewhere, and in the States. And I think people and generational ideas of people are extremely important. I wanted you to talk more about this issue about visas. Because you may say you've got a problem, we've got a big problem in this country. And it seems to me that any economy that doesn't find a way of keeping the best and the brightest and bringing them in is going to suffer and is eventually going to die. What's happening in the States and what's your solution for the human capital challenge of bringing the brightest and the best into the economies to enable these new ideas to be generated?
Really interesting question. So, and there's a bit of context, I mean, you may know this, Stephen, but the government here has put a cap on migration from outside the European area into the UK, and some of the freedoms, particularly for students to stay in the UK after they've completed their studies, have been rolled back compared to previous administrations. And I think something similar has been happening in the US.
We write in the book that the only sustainable source of any nation's competitive advantage is in education, is in talent. So any country that is not making it feasible or attractive for, the global economy today is really a competition for talent, right? And so any country that makes it difficult for the best talent to come into their nation is only putting themselves at a disadvantage. I think when you look at a larger economy like the United States with 330 million people, I think there are two issues. One, when you hear our companies so vociferously saying we need H-1B visas, we need more openness to high-skilled talent. I'm all for it. However, it's a signal that our education system is not producing the talent we need domestically. So we're not in science, technology, engineering, and math, and STEM education. It's a signal to us that we're falling radically behind. So it means we got to fix that while also opening our doors to entrepreneurship. For smaller countries, for a UK, where a third of your workforce in the life sciences sector is foreign-born, it's even more significant that you open your doors to the best talent. What are we doing in the United States? There is legislation now in the Senate that fortunately has co-sponsorship between Republicans and Democrats called the Startup Act 2.0. And if this is passed, which hopefully it will be this spring, would significantly open up the doors to high school immigration and solve some of these H-1B visa caps we have in the U.S. So I think you'll see, as one of the top 3 innovation initiatives in the U.S. this year, immigration reform on the high school side.
Can I just, on this point, can I just put one thing which I hear sometimes, which is that one of the interesting things about the internet and modern communications technology is that actually you can run a business with your staff spread around the globe, right? So it may be that a business can't bring a programmer into a particular country to do that job, but they can still access them remotely, and you can still work on the same product, and you can collaborate and so on. Does that help us through this at all, or do you need to get people physically together?
No, I think there are some sectors, certainly in information and communications technology, in software design. When you look at Microsoft, they're coding 24 hours a day, and they have one software program being passed around the world by developers in the US and Israel. So I think that's a sector where some of this can be addressed online. But when you look at some very advanced manufacturing sectors like biologics, like life sciences, like semiconductor manufacturing, the connection between R&D and the manufacturing process is so tacit in nature that it really has to be interpersonal connection of that knowledge, because the R&D and manufacturing go hand in hand. And if you make it difficult for that talent to be there on site, I think you just damage yourself.
Okay. The lady at the back.
Whether it tackles tariff and non-tariff barriers, as you mentioned previously, and how you see it impacting on the global institutions such as the WTO, because you have the EU and the US having some sort of trade union. Could you not see that undermining the agenda?
So, a couple of things. Some studies have shown that if we were to enact a North Atlantic Free Trade Pact, we'd increase the two-party GDP by $180 billion per year, within year 2. So there are, I think, massive gains to be made if we were to go down this route. I know that there was a high-level working group that was established last fall between the United States and Europe, so they're starting to work on this and should see some progress down this path in 2013. The first thing we should do is go to 100% tariff elimination between the US and Europe. I think we can agree on the tariff equation. Obviously, when we talk about non-tariff barriers, we're going to get into more difficult conversations around the services. Trade service is a big problem because of certifications and medicine or law. Obviously, we have different approaches to antitrust policy. So this will obviously be a work in progress, but I think the important thing is to start down that road now with the things we absolutely can't agree on, like the tariff barriers, and then put in place a plan for the trickier stuff to get there over the next 5 to 10 years. We actually, at ITIF, are not being flippant when we say that we really feel there's a battle being fought right now for the soul of the global trading system. We look at some of the policies that are coming out from the BRIC countries, and what's happening is countries like India, Russia, and Brazil are looking out at the world, and they're saying there are these two paths. There's this Western free market, market-based trade, globalization path, and then there's Well, to be honest, what we say is that there's a status path, very much China-like, where the country engages in more innovation, mercantilist practices, more government direction in the economy. And these countries are saying, which path do we want to go down? And they're looking and seeing not very good economic results from the West, and they're seeing this explosive growth in China. So I think we have a lot to do to prove to the countries that we want to buy into the global trading system that this is still the way to go. This is still the way that will generate the long-term positive economic growth for your society. And what I'm saying is, obviously, the Doha round broke down. There's no momentum globally, so everything's stagnating. I mean, it's really got to be the West that picks up the ball now and charts a path forward for continued global liberalization and trade integration. And unless that happens, we may lose some of these countries to a different economic path that doesn't suit them or us in the long term.
The lady in the front row.
I'd like to follow up
The
on
microphone's just arriving.
Irina Somerton, Institute for Research, University of London. I'd like to follow up on the Palestine partnership. As I mentioned to Mr. Ezell when we were chatting before we spoke, presently in both the European Union, and you must be aware that this TAP has been supposedly in the works for at least 10 years. No progress has been made. And I have to say, I think it didn't do everything the European Union does. Don't get around is, still being around in 10, 20 years in the same point it is now, and absolutely not. The United States, should be polite to the European Union, but really not waste time on that. It will never go through. The European Union does not seek free trade. They talk free trade, and they put up non-tariff barriers as much as they can. There's a mind-boggling number of WTO lawsuits between the USA and the EU. And the US plays our role in this case sometimes, but they don't cheat to the degree that the EU does. I'll stop now. I wish the US, I don't think the US government takes it seriously anymore. I think they're at the stage of just being quiet about it.
Good question. And it's interesting, isn't it, how these relative measures of time, whether 10 years is a short time or a long time in international negotiations.
Well, one of the other reasons that we advocate for the U.S. pushing for this is because, as bad as the EU may be in some ways, it has at least negotiated 16 free trade agreements on a bilateral basis in the time that the U.S. has negotiated 3 over about the past 8 to 10 years. So we're advocating for more leadership of the global trade agenda.
Well, I hope the USA
Okay, back.
Hi, I'm Elizabeth with Facebook. I wanted to press a little bit on the challenge that I think some of our policymakers face when it comes to innovation, which is that, especially given the role that I play at Facebook, teaching politicians and government officials how to actually use Facebook, is this idea that there's so much misunderstanding on how the products and the tools that are deriving so much of the economy, whether it's in California or anywhere in the world, how this fundamentally works at a very basic product level. There's something about the internet, because you can't see it. You can't tour a manufacturing plant and understand how the car is made. It just becomes some kind of secret that I think breeds misunderstanding, especially what we're seeing in Brussels with this week's announcement on where the data protection directive is going, which frankly is worrying. So I just wonder, given that, and I agree with you that innovation is a policy issue, what can we do as a new generation of leaders who have been brought up in an internet age to help raise this awareness and understanding amongst policymakers about the importance of taking seriously the internet's ability to continue and to thrive and play a role in future businesses and companies?
What a good question. What is the equivalent of taking someone to see the factory when it's all online?
I mean, there's so many answers to that. One of the ones I'd like to, that all policymakers should know is that we have great companies like Facebook and Google and eBay out there today, and so many politicians think that they were the complete products of the free market that came into being without any government involvement whatsoever. Few people know that Google got its start with a grant from the National Science Foundation Digital Library Science Initiative. So even for these sectors of the economy, ICT, even back to the beginning in the 60s and 70s, it goes to the investment in the semiconductor sector in Silicon Valley that started this all. So pointing some of the history of that it was a partnership between government and the private sector that brought many of these things to bear, I think is a place to start. On the internet side, one policy issue is proving that the internet actually does not cost jobs. Because I was actually, I've spent a lot of time talking to US Congress members, and I went in and was talking to one representative last year about the need for innovation, about the need for us to invest more in R&D and research. And he said, but Steve, isn't innovation the problem? Isn't innovation why we got into the financial crisis in the first place? Isn't innovation costing Americans jobs with the internet, and they're taking away jobs? And then McKinsey finds that for every one job the internet destroys, it creates 2.6 jobs elsewhere in the economy. So it has an economic growth driver. To try and actually answer your question, we actually did a project with the US Congress called the House of the Future, looking at how information technology was going to transform how it connects to the population, how governance will change over the next decade. And you see some amazing things come out like that, right? In the US Senate, there was a prohibition on the use of tablets. Like you could only come in, and if you're going to speak, you had to be on paper. You're not allowed to use tablets. It's all this crazy stuff that's anti-technology. And even getting the U.S. Congress to support the use of Apple products on the floor was like a 5-year fight for Apple because we're not. Anyway, the point is, what we discovered was you had to engage the change agents. You had to engage the people who believed in the technology, believed in the future. You engage the early adopters. You teach them, and they're the influencers. And once we got those guys who understood, then they were able to bring everybody else along behind them to show the power of these technologies and what they could do. So I think that's part of it, and just education across the board from day one is just critical.
Elizabeth, I'm curious just about, so is this, in your experience, confined to politicians and policymakers, or would the same be true of the CEOs in large organizations and their boards? Or do they get it and politicians don't?
I think of the people I have worked with, I think you're exactly right. It's a wider problem than just politicians. I think though what, even in foreign policy, there's a great misunderstanding that the internet and sites like Facebook and Twitter are actually partaking in foreign policy making in the 21st century. But I think what bothers me most is that sometimes there's a tendency to just say, well, this is something that young people understand, but we just don't get it. And it's not really necessary for us to get it as long as we make good decisions. And I don't think that's true. I think there are equally a number of CEOs, and politicians who understand it very deeply. That it's a matter of opening the mind. It's not something that you have to have, been born with to understand. And I think every time I hear that, I really cringe because I don't think it's true.
Okay, thank you. Before I joined ITIF, I co-founded this research and innovation consulting firm called Pure Insight. We work with companies on innovation methods. One thing that was really apparent from that work, and it's slowly changing, but the CEOs of most industrial companies, especially in the US, when they went to business schools in the 70s, they were taught quality, they were taught lean, and they were taught improvement. They weren't taught innovation, right? And innovation is fundamentally a different skill set. Innovation is synthetic, it's creative, whereas quality is reductionist, right? And so it's really been the job of that layer of managers coming on now to really bring this new knowledge of, there's so much now, firms like Doblin and Monitor and IDEO, just methods of innovation, methodologies, types of innovation. There's just a whole new science of innovation that's been discovered. And so it's that mid-tier of change agents in the company that have to teach the senior executives, how do we really bring innovation to our firm?
That's the lady right at the back.
April now, night and morning. I wanted to raise the issue of the West sort of being stuck with 20th century technology and the emerging economies leapfrogging and going straight to 21st century technology, and how that impacts their economies versus what happens to all of us in the West. And an example of that is what GE has done in investing in electric car technology. And in 2009, Jeff Immelt talked about this investment as the biggest investment in the history of GE, and the market being China. And he said, we won't create jobs in America because we'll build our plants in China, where our market is. And he said, unfortunately, he said, there isn't enough government policy in America to propel the American consumer and incentivize to buy electric cars. And, you know, what's going to happen? I mean, you know, the Chinese have state capitalism. They decide to get a game, and they play it backwards, how they want it, what you described as mercantilism. And the U.S. and the West, Europe is still involved in free market economy and markets and so on. So how do we compete? Maybe we can't. And so it's really going to take government policy and putting some teeth into it to ensure that consumers in Europe and America have the same advantages as consumers in China. Could you speak to that?
So, okay, a couple things there. You're exactly right. I mean, in the United States, we have this attitude of, we're number one. We've always been number one. We'll always be number one. And it's difficult for us to take seriously the competitive threats that are coming from developing countries like China or India. I mean, when you look at investment in clean energy technology over the next 5 years, at current rates, China is going to invest 3 times as much as us in actual dollars in clean energy technology. In life sciences technology, as a share of GDP, they're going to invest 4 times as much. I mean, China has now 40% of the global capacity for genetic sequencing. So, so they're serious competitors with real strategies to capture global market share in these advanced industries. And if we don't take it seriously, we're in real trouble. Now, I don't think that it means that we can't compete. I still think that with leveraging our strengths, right, which is entrepreneurship, which is dynamism, churn and change in our economy, a political system, right? If we can capitalize on our strength of being a creative environment, an environment where you can express yourself, and leverage these strengths to attract that type of talent and that type of investment, and put in place this whole innovation ecosystem and the good policies we're talking about, we absolutely can't compete. But it's not going to happen if we just leave it to industry to decide by themselves, because to the point of GE, they're going to go to the monopolistic marketplace where there's a billion or more people right there. There's another component to this, which we hear all the time. People will say, well, Steve, as long as the American consumer has access to the Apple cell phone and the hybrid electric vehicle and the good semiconductors, it doesn't really matter where in the world it's produced, as long as our consumers can benefit. And that really signals a problem with neoclassical economics, and that's confusing consumer welfare with producer welfare. The problem is if we're not giving our workers good enough jobs to buy those technologies, because then we're really, it doesn't really matter, right? So that's why I was going back to talk about focusing more on production, the production economy as opposed to the consumption economy. But you're exactly right. We will not succeed unless we have sophisticated innovation ecosystems in place to compete in these high value-added sectors, which is the only stuff we can reasonably expect to compete in the world.
And how?
That speaks to the issue that we're comfortable with 20th century technology, and we're not, government policy is putting teeth behind, really encouraging the private sector to go to 21st century technology, to renovate our grid, right, our electric grid. There are certain states like Colorado who've gone after that. So what happens to the rest of the country? So where's the policy behind this?
So, in a lot of these advanced digital platforms we're talking about, we actually have a series of reports called Explaining International Leadership in Advanced Information Technologies, intelligent transportation systems, mobile payments, near-field communications, smart grid, health IT. And this series of reports finds that across the board, quarter 1, 2, and 3, it's Japan, Korea, Singapore, and the Asian countries. Because it's a chicken or egg problem in a lot of these cases. especially with digital technologies. If you look at, say, mobile payments, which you do the swipe, well, it requires a whole ecosystem of actors moving in concert to deploy these technologies, and firms won't deploy it if the infrastructure is not out there where you can use it, if you don't have the fueling stations for the hybrid vehicles. So you have to solve these coordination problems across an economy, and that's where a lot of these countries excel. So what's part of the solution? That government actually gets involved, not just to be an investor, but an early adopter, a first mover in the adoption and deployment of these technologies, and then pushing them throughout the broader economy. So you're right, more teeth with government policy. And
the mobile payments is really interesting to me because I guess one of the arguments there might be that, so in the West we had a whole bunch of innovation over previous decades that have delivered smartphones and wireless networking infrastructure and so on. But actually the ability for me to wave my mobile phone over something and pay for a sandwich is still not brilliant in the UK. And we've seen some African nations which weren't encumbered, if that's the right word, with lots of our legacy infrastructure, go straight to the M-Pesa format, and they solved it, right, with text messaging and are way ahead on mobile payments. So it's a really interesting dynamic question about, does my innovation today, how do I make sure that doesn't hold me back in 10 or 20 or 30 years' time? What can one do to future-proof innovation?
I mean, this is really the frog in the frying pan issue, right? I mean, it's good enough. We really, we're satiated, we're happy, we're at a relatively high level of income, and that's why you just carry on. So let me offer this. Innovation is fundamentally about the transformation of existing conditions into preferred ones. It's about advector raising, and it takes leaders, both in government, in the business sector, to stand in the future and provide, a vision of the world we want to see, and types the place of policies and investments out there. It requires vision and leadership. Otherwise, it's time.
Okay, at the front. Okay, well, we'll start with one, and then see how we go. So just remind us who I'm with.
Mark Walters, competitiveness nations, has a very nice summary at the end of how economies develop. The last two stages are innovation-driven economics and then wealth-driven economics. And wealth-driven economics is the point to which vested interests outweigh the incentives for innovation. Do you think that's where we've got to? That's the first question.
Okay, let's start with that.
Yeah, sorry. Is it working?
Okay, there we go.
The Michael Porter's book, Competitive Advantage of Nations, has a very nice bit at the end where he talks about the 4 stages of development through which economies go, from the Roman Empire to the United States. Big picture stuff, this. And he says, the resource exploitation, investment, innovation, and then at the last stage it's wealth-driven economics. And in the stage of wealth-driven economics, the accumulated wealth outweighs, in terms of incentives, the returns for innovation. And so innovation stops and the economy declines. Is that where we are? And if so, how do we get out of it?
Have we got so wealthy that actually the incentives
We
for
don't
innovation
care about innovation. Yeah, we're too interested in our. Are we happy with 20th century technologies?
Okay, Steve.
Almost.
I think you can argue that where we have reached in our political economy in the United States is that we're far more concerned with allocating the wealth we have than accumulating new wealth for the future. Creating and accumulating new wealth for the future. So it's a redistribution game, not a growth game. So I think we have to push it towards a growth game. That's what delivers the broadly shared wealth that the entire society participates in, move us up, solve that. We haven't increased our minimum wages since 1983, solve the income equality problem. I think you absolutely have to have entrepreneurship to do that. You have to preserve the ability to challenge established incumbents in an economy.
Isn't the real lesson that of the sort of Porter type story, if you lose the innovation edge, you don't stay where you are,
That's exactly right.
Okay. Let's take a question from the gentleman at the back.
There's a lot to be careful about what mobile is doing in Africa, but I think it's overstated and it's overhyped. The best estimate of contribution of mobile technology to African GDP is about, at the best, is 1%. And if you look at most of the underlying technology, if you want to speak from perspective of production economics, they are imported. Africa is ever reliant on imported technologies. The industrial and the manufacturing sector is the weakest. And if you're going by the history of development, there's no country or region of the world that has developed, at least come close to Western standard of living, without a strong industrial and manufacturing sector. And that is non-existent. You can't have that leap in GDP growth and in well-being without an industrial policy, and it's not happening. So, fine, there's a lot that's been done, and mobile technology has, and again, it's more of a pent-up demand.
Yeah.
Like communication is a very, very social feature of human being, and Africans are very, very social, and that has really, mobile telephony has really driven that, but it's not really adding anything to productivity. Yeah. And that has to be put into perspective. Thank you.
There's a point about the importance of manufacturing, you touch on in the book, don't you? When you talk about the causes of decline in the US and the UK, one of the things you say is that policymakers on both sides of the Atlantic got themselves in a position where maybe they thought manufacturing maybe didn't matter, or mattered once but didn't matter anymore, and you would say maybe that's not quite right for all countries.
No, Michael Boskin, who was the chief economic advisor to the first George Bush, was famous for saying, $100 of computer chips, $100 of potato chips, what's the difference? It's $100 of economic output. And they really believe this. This is a neoclassical perspective that's just fundamentally not concerned about the industrial composition of an economy. You know, even Larry Summers, who was Obama's chief economic advisor, said, and I quote, America's role is to feed a global economy that's increasingly based on knowledge and services rather than making things. And Christina Romer said that there's no difference between haircuts or manufacturing in our economy, and to support manufacturing is just based on sentiment. But I think the reality is manufacturing is a vital traded sector. It generates higher levels of employment and economic multipliers than just about any other sectors of an economy. It's critical for national defense. And the type of manufacturing we want is very high-tech, very high-end. So I think a country that feels it can, well, especially a large country like us, that feels it can get along without being concerned about its manufacturing sector is going to find itself in trouble.
Okay. Who else would like to, gentleman at the front?
Jonathan Thornton. I'm a venture capitalist. I apologize, I went to business school in the 70s, which apparently makes me completely out of touch. But I'm just reflecting on this innovation versus manufacturing versus brains. And I take the point that we can't be complacent about losing manufacturing capacity. That is absolutely true, because the Indias and the Chinas start being outsourced places which are cheap. And already it's moving to Cambodia and Vietnam for that lot. So China is well ahead on the game, and so is India with brains and technology. So we've got to keep up in every area. Now, the thing I've noticed is 2 points, really. One is that the small and medium-sized enterprises, which I've been involved in for 40 years, are where the innovation tends to happen, as a big generalization. And also, it's the places where jobs are created. There was a study in Massachusetts 40 years ago, 30 years ago, that jobs were being created in the small and medium-sized enterprises, which is people that employ between 20 and 500 people. And that's where the jobs are being created. And never underestimate the energy there is in those companies. Just go to the Oak Street roundabout and look around there if you want to see it. So, but the other point is that government and that small and medium-sized sector, as was made earlier, do have to work together. And I've seen it because I've been involved in a venture capital company for 15 years, roughly, and our return to our investors is 12% per annum. But if it wasn't for the government incentives in that area, it would only be 5% per annum. So 12% is rather nice, because I'm a major investor in those funds. 5% is a real bore. Could have done better putting it into buy-to-let property. So, you know, that's what we must never forget. We don't want to get right-wing and left-wing about this. We want to combine the two. I was fascinated about Google. Incidentally, also in Kenya, when they started mobile payments, mainly because there was pretty poor banking, and you could use your mobile phone to exchange money. You could go to a bank and get money out with a mobile phone. That was funded by the British Overseas Aid Programme under DFID, that software, and I think it works. I've got a question, sorry.
Let me respond a couple points there. Absolutely, that manufacturing is critical, but a recent World Bank study found that 25% of the growth in Kenya's economy since 2000 is directly attributable to the deployment of ICT, information and communications technologies, and they have data showing that for developing countries, a 10% increase in mobile phone penetration leads to a 0.8% annual increase in GDP, and same with a 10% increase in broadband internet delivers 1.2% increase annually in GDP. So I think ICT especially is critical to platform for development.
I'm not disputing the fact that ICT in general, not only mobile. Of course, mobile is now going to be the next platform on which ICT will thrive on. But the figure in Kenya, as I said, is about pendant demand. Of course, that's what David did with M-Pesa is a good example of how smart development aid can support development in developing countries. What people don't know, Vodafone or Safaricom gets the credit, but it was David that put out exactly 1 million UK pounds into the research. And what they did actually was nothing new. It wasn't that it was just a social phenomenon that was already ongoing, and some social researchers found out that, wow, this thing could actually, if we could study it and formalize it, and they did. And then Safaricom, initially Safaricom and GSMA developed CodeFit. They thought there was no marketing more money to be made there, but when the research was done and everything was formalized, and that's when they came on board and they took all the glory. The point I'm going to be making is that, and going back to the point made earlier, is about virtuality and physicality. We all know that ICT services are very fleeting. You need actually the real growth and the main value, and where you create job and you create manufacturing comes from making the tangible things, not the intangible things. And actually history shows that for you to even become a world leader in the virtual things, you need to have an underlying manufacturing sector, because that's where the skills come from, and that's the point I'm making. I'm not disputing the fact that ICT service can make a difference, it can make, but it's very intangible if you put everything into perspective. For example, the point I'm making is that the GDP of the whole African continent, from Cairo to Cape Town, from Mozambique to Morocco, is less than that of New York State. That is how small African economy is, and it's because the industrial and the manufacturing sector is very, very weak.
Okay, thank you. And can we just come back to this point about SMEs and innovation briefly, because you were saying a lot of the innovation anecdotally happens maybe among the smaller businesses. I mean, where does that figure in industrial policy and innovation policy?
So, going back to 1997, the US has lost 47.5% of its manufacturing employment. Y'all have lost 53%. Germany has lost 7.5%. Mind you, they pay their manufacturing workers 40% more per labor hour than we do in the United States. So manufacturing is not in universal decline across all countries. How has Germany achieved that? Well, a lot of it is through the strength in its middle stand in its SME sector. When you look at the manufacturing intensity of its economy, 60% of German manufacturing is in high-tech or medium to high-tech industries. That's like R&D's a percentage of sales. In contrast, 40% of US and UK manufacturing is high-tech. So they have migrated up to the high-end, the high value-added stuff in niche areas. And they did something critical in 2006 with their Kurzarbeit program, where when global demand decreased because of the recession, instead of just blanket firing employees like we did in the United States, they said, we'll take you down to half-time, fill the demand we have. And in the meantime, the government stepped in and filled the gap with money to educate and train them on the next generation of skills. So now that the global economy rebounds, Germany still has a workforce in place to fulfill the demand, and they have retrained all of their employees for the next generation of technology. That's very smart. Also, when you look, there are programs. You have like the Manufacturing Advisory Service here in the UK. It supports the productivity and innovation capacity of SME firms. We have a program in the US called the Manufacturing Extension Partnership. Japan's got one, Taiwan's got one. Germany invests 20 times more, and Japan 30 times more as a share of GDP in supporting SMEs innovate than we do.
I know we've got several questions people want to put forward, so why don't we take 3 together. So the gentleman just there, and then please.
Carl Allen, I'm retired. We talked a lot about the good things about innovation and increases in productivity. Can we talk a bit about the bad things that come with it? For instance, technological unemployment, which seems to be, what shall I say, looks like a permanent feature of developed economies, and how wide is that gap, and how is it going to grow or come down between job creation and job loss?
Take a couple more. The 2 gentlemen need their hands up.
Hi, yes, my name's Luke Hilliard and I work for the High Pay Centre. I was just interested in what you said about Google relying on government funding to kick it off. I think the same is true of Apple and a lot of companies in Silicon Valley. A recent pamphlet I read from the Demos think tank in the UK said that I think the US government provides about 52% of basic R&D funding in America. It's about 30% in the UK, so less but still significant. At the same time, the way that, to my understanding, that the UK government has tried to incentivise innovation has been through reduced capital gains tax, reduced corporation tax, in the hope that business will invest more in innovation. But if anything, the trend's been in the opposite direction in recent years. So do you think that there's some sort of discordance in government policy in that respect? And do you think there's a sort of practical and moral basis for government getting some sort of return on its investments?
One more. Your next door neighbour.
Hi, I'm Will Andrews Tipper from Green Alliance. I'd just be interested in your observations on the different approaches taken by different countries to explicitly green or low carbon innovation, and what that means in terms of their relative competitiveness.
Okay, so question about some of the bad things that might come along with innovation, in particular technological unemployment. Something about what's the role for government funding of R&D versus looking to the private sector, and whether we should be spending more or less on that front, and then green tech and low carbon innovation.
You may have to remind me.
Yep. Okay.
Go through. So the first question, this really echoes a book that just came out recently by Eric Brynjolfsson at MIT called The Race Against the Machines, where he makes precisely this case that productivity increases brought by ICT are going to be a real threat to jobs going forward, as now we can digitize everything. Even our president last June on the Today Show with Katie Couric said, Katie, the reason unemployment is so high in the United States is because we're losing bank teller jobs and grocery store checkout jobs to technology. So I think this is a common fear, but every OECD study that's ever looked at the relationship between technological shift and productivity growth and its impact on jobs finds that while there are displacement effects in the short term, over the medium and long term, enhancements and improvements in technology and productivity generate more job growth for an economy. And we're going to see, and it's going to be heartbreaking, stories in the press that somebody lost their job because we went to the automatic checkout and a grocery store person lost their job. I think a couple things, this happened, but a few things happen, right? That essentially saves cost for the firm that get played out throughout the rest of the economy, whether it is to decrease the price of groceries, which enables you to go out to dinner more often or go to a movie. Those gains are reinvested throughout the economy in a more efficient way that drives long-term growth. And I think it's very important to make that case with politicians. Now, it does mean that we're going to have to continue to be on the front end of training our workforce, both those coming into the economy out of primary education and those who need to be reskilled for the jobs of the future. The increasing pace of technological change forces countries, more so than ever before, to have a workforce strategy that equips their citizenry with the skills they're going to need to compete in this global economy. I met with, on the book tour, I went to Finland, and there was a person from the Finnish Confederation of Industries, and she said, you know, Steve, we have our mission statement for high school education in Finland is that we produce high school graduates in Finland with the communications, analytic, and language competencies to compete in a global economy the day they get out of high school. And that's the kind of bar we have to meet if we want to address this challenge on the productivity side.
Okay. And then we had a question about government funding versus incentives for private sector funding on R&D.
So I think your statistics are right. I think it's probably now about 38% of U.S. R&D is government funded, 62% is private sector. But I think a couple things here. I think it's critically important that governments design their tax code to incent the types of behavior they want to get out of corporations. Corporations underinvest in research and development to societally optimal levels because they can't appropriate all the benefits of their innovative activity. So I think it is critically important that countries have effective research and development, research and experimentation tax credits that incentivize firms to invest in R&D and in plant and equipment and workforce training that spill over to the broader economy. I think that absolutely has to be part of the equation. I think, though, it's vitally important to be focused on R&D efficiency and the output countries are getting. You know, a big problem in many countries is so much of federal R&D goes to university ivory towers, or in the U.S., national laboratories. And there isn't a lot of analysis about how are we putting in place any structures for this R&D ultimately to get commercialized or to get passed into the private sector. So countries like Sweden now, what they do is they're allocating about 10% of their university R&D funding based upon that university's ability to attract private sector co-investment with them in their research projects. So I think being more focused on how federal R&D money that goes to universities, where most of it does, can bring in industry money to co-invest in some of these challenges is maybe a way to get at some of that efficiency question. One other thing briefly on this is when you look at the U.S. R&D portfolio, 90% of federal R&D now goes to mission-oriented activities, and that's either defense or healthcare, whereas the EU average, or the OECD average, is about 50% going towards like directly supporting economic growth. So we have a real imbalance now, we feel, in how we're funding R&D in the United States. It's not really being designed to lead to the commercialization of new technologies. If you use DARPA, our Defense Research, Advanced Research Projects Agency, in the 1970s, it had as its mission to invest in leading edge technologies that had both a defense and a commercial application. But since we went to war in 2001, DARPA has taken out that commercial thing, and it's completely focused on supporting the warfighter. So we have a real problem there. And then on the clean tech question, was that the last one? Was I'm going to punt on that one by saying at ITIF, I have 3 colleagues who run our clean energy shop, and we have numerous reports on clean energy technology, the clean energy economy, and they're my experts there, and you need to talk to them. I'll put you in touch with them.
Okay, excellent. I'm going to take one final round of questions if people have anything else they want to chat. So Tony at the front. The microphone's on its way.
Thank you very much. I'm involved in the OECD knowledge-based capital sort of work. I don't know whether you've followed that, but it's the way of looking at the economy and counting as investment all of the accumulation of research and software and workforce training and
intangible assets.
Intangible assets, all that stuff. Do you think that's got a useful role to play in the sort of initiatives that you're trying to do? Because, I mean, we see it as a way of presenting to the finance ministries the investment that they don't normally count.
Okay, so hold that thought. Are there any other questions people would like to throw in as we approach the end? No? Okay, well, we will go all out on that one then. Is it worth trying to count the knowledge and the intangibles in the economy? Is that a helpful thing to do?
No, I mean, I think it is. I mean, it's certainly helpful to help countries compare the extent of their intangible stock vis-a-vis one another to see where they might have deficits, where there might be weaknesses. So I think there's it'll help countries understand where their gaps are and where they can be filled. And I mean, the only way our countries can compete going forward is in knowledge-based sectors, whether it's in products or in services. And you have to have both. And the stock of intellectual property, the stock of goodwill, and all these intangible things, you know, these are going to be critically important differentiators going forward. So at an economic level, it absolutely behooves us to understand them and provide an accurate picture of where we lie. If I may just say one final thing to cap this whole discussion, I think it's great that these conversations are happening on both sides of the Atlantic to find where that right space is for government to support innovation. In 2006, Germany introduced its high-tech strategy of Germany. I encourage you to take a look at it. It's just fantastic. Germany calls out 20 sectors in which they want to lead the global economy. They look at the strengths, opportunities, and weaknesses in each sector, do a full SWOT analysis. What was interesting was a study by the German Confederation of Industries done 3 years later in 2009, where 30% of German companies attributed their successful innovations over the past 2 years to improved federal research and innovation policies. So this can make a difference. There are ways to get it right, and it is becoming a differentiator for countries.
Okay. So, on that note, I think it's been a really, really excellent conversation. Steve, we're thrilled that you could join us for this. Thank you all for your questions and participation. If you enjoyed this discussion, then you'll be pleased to hear that we have a whole series of events on what a modern industrial policy should look like for the UK coming up. So there are flyers on your chairs. We've got David Willits, Lord Heseltine, and Lord Adonis coming in to talk about different aspects of this debate. So I hope to see you at some of those sessions. But for now, Steve, thank you very much. And everyone else.